So, what happens when the poster child for a whole nation's digital revolution launches the biggest stock market debut in its history, only to completely spectacularly implode? Well, you're about to find out. This is the story of the absolutely dizzying rise and the brutal crash of Paytm.
This was the headline that just shattered India's tech dream. After years of relentless hype and literally billions of dollars in funding, the historic IPO of what was supposed to be India's one and only super app, well, it met a very harsh, very unforgiving reality. It left millions of investors just staring at their screens, stunned, all asking one simple question: what on earth went wrong?
I mean, just look at this timeline. It shows you the whole roller coaster. It started out pretty simple back in 2010, just doing mobile recharges. But then a single government decision in 2016 sent it into the stratosphere. By 2021, it hits its absolute peak, only to come crashing right back down by 2023. It's a classic boom and bust story. And trust me, every single moment is packed with lessons. Okay, so to really understand the crash, we first have to get a handle on that incredible ascent. How did a simple little mobile recharge platform become this indispensable part of daily life for hundreds of millions of people? It really boils down to one single event that changed everything: demonetization. Back in 2016, the Indian government basically invalidated most of the country's cash overnight. You can imagine the chaos. Suddenly, everyone, and I mean everyone, from the person selling street food to the biggest retailers, needed a digital way to get paid. And there was Paytm, with its super simple QR code perfectly positioned. This wasn't just growth, it was a massive societal shift, and Paytm was right at the heart of it. So with that kind of explosive user growth, you know what comes next, right? A tidal wave of cash. We're talking the biggest names in global venture capital. Think China's Ant Group, Japan's SoftBank. They poured over $2 billion into the company. It was an all-out war for market share, and the story was set. Paytm was an unstoppable force, backed by what seemed like unlimited capital. All that growth, all that funding, it was all building to one single moment: the absolute pinnacle of the hype machine, the initial public offering. $2.5 billion. Let that sink in. This wasn't just another tech IPO. This was the largest, the biggest in the entire history of the Indian stock market. It was a national event. It felt like a symbol of India's startup scene finally arriving on the world stage. And oh man, the media loved it. Headlines like this were absolutely everywhere. The comparison to Alibaba, the Chinese e-commerce and payments giant, it framed Paytm as more than just a company. It was a national champion, and it was destined for greatness. The expectation wasn't just for success, it was for total, complete market domination. But the celebration was, well, it was incredibly short-lived. The champagne bottles were barely empty before the market delivered a swift and just brutal reality check. The dream, almost overnight, began to unravel. And this was the result. Within just a couple of years, the stock had lost 3/4 of its value. 75%. Poof, gone. For all the everyday investors and the big global funds who'd piled in, it was a catastrophe. The poster child had become a cautionary tale. So what happened? A huge piece of this puzzle was strategy. See, Paytm tried to become a super app for absolutely everything: payments, banking, stock trading, you name it. But in the meantime, their rivals like Google Pay and PhonePe, they did one thing and they did it exceptionally well: simple, reliable payments. Their laser focus allowed them to just steadily chip away at Paytm's market share. And here's the really uncomfortable truth that all that IPO hype had managed to hide. The core payments business, the very engine of Paytm's growth, it was actually losing money. The company was just burning cash to get users. And on top of all that, as they tried to expand into banking and finance, they ran smack into a wall of regulatory scrutiny that they just seemed totally unprepared for. The foundation was way weaker than anyone realized. So what are the lessons here? Because this isn't just a story about one company going down. It's a really powerful lesson about startup growth, about hype, and about the critical difference between a high valuation and real sustainable value. This really is the central question, isn't it? I mean, they had hundreds of millions of users and billions of dollars in the bank. On paper, they looked absolutely invincible. So why did they stumble so badly? Well, it pretty much boils down to three universal lessons for any fast-growing business. First, confusing a giant pile of funding with an actual profitable business model. They're not the same thing. Second, underestimating the referee, in this case, financial regulators who can change the rules of the game overnight. And third, the curse of the super app. In their quest to do everything, they failed to master their one core essential business.
This whole philosophy, it's known in Silicon Valley as blitz scaling. The big idea is to grow so incredibly fast that you corner the market before anyone else can. But this brings up a really fascinating question. Did all that funding actually hurt the business? You have to wonder. In Paytm's case, the relentless focus on scale just hid a fatal flaw, a business model that simply wasn't making any money.
At the end of the day, the Paytm story is a powerful reminder that virality and scale, they just can't replace a clear path to profit. It proves that a little bit of arrogance can create some fatal blind spots, and that no brand is too big to fail. It's a truly sobering lesson from India's startup boom. So, what do you think? What boom or bust should we break down next? Let us know.
So, what happens when the poster